All right, let's talk about one of the most fundamental tools a trader has in their arsenal, the moving average. You know, it's all about answering that one crucial question before you even think about placing a trade. Which way is the market actually going?
You pull up a chart, and what's the very first question that hits you? Is this thing going up or is it going down? I mean, everything hinges on that, right? Get that part right, and you're already halfway to a solid trade.
So how do you figure it out? Well, one of the simplest ways to start is by just throwing a single moving average on your chart. We'll call it the one-line method. And trust me, it's about as straightforward as it gets.
So what is a moving average, really? Think of it like a noise-canceling filter for your chart. It takes all that chaotic, spiky price action, the up and down madness, and just smooths it all out into one clean, flowing line. Suddenly, you get a much clearer picture of where the market's really headed.
And the rules? They couldn't be easier. If the price is hanging out above that smooth line, boom, you're looking at an uptrend. And if the price dips below the line, well, you've got yourself a downtrend. It's a really clean, simple visual cue.
Okay, let's check out a real example. What you're seeing here is a 10-period simple moving average, or SMA. All that means is it's just averaging out the price over the last 10 candlesticks. Now look closely. See how the price is just consistently riding above that line? That's our rule in action, right there. Price is above the average, which is screaming strong uptrend. This is exactly the kind of clear signal that tells you to start looking for a chance to buy.
I know what you're thinking. That seems way too easy, right? Just follow one little line and you're golden. But come on, if trading was that simple, we'd all be sipping drinks on a beach somewhere, right? We'd all be millionaires.
Yeah, there's a catch. And it's a big one. It's called the fake out. And this is exactly where that super simple one-line method can get you into a whole lot of trouble.
So let's set the scene here. Picture this. The market's been in the pretty clear downtrend. Price has been staying safely below our moving average. But then you see this. The price makes a little move and it pops right up above the line. So what does our simple rule tell us to do now?
Exactly. You see the price cross above the line and the light bulb goes off. You're thinking, aha, the trend is changing, this downtrend is over, time to buy this sucker. You feel that rush of confidence, you hit the buy button, and you're just waiting for that price to soar.
You're all in, totally convinced you've nailed the turning point, but then,
Bam! You got faked out. The price just stalls out, it reverses, and it plunges right back down below the moving average. That little pop to the upside, it was just noise. It wasn't a real trend change at all. The downtrend just picked right back up, and now you're stuck holding a losing trade. Ouch.
So how do we stop this from happening? How do we avoid that trap? Well, instead of just relying on one line, we're going to bring in a second one for confirmation. This two-line approach, it's a much better way to figure out what the real trend is.
let's just quickly break down why this is so much better. The one-line method, it's all about price crossing that single line, and as we just saw, that can totally lead to fakeouts. The two-line method is different. It's not about the price, it's about the relationship between the two moving averages themselves. And that gives us a way more reliable signal.
Okay, so how does it actually work? Simple. We use two moving averages. We have a faster one, let's say a 10-period, that reacts really quickly to recent price changes. And then we have a slower one, maybe a 20-period, that's much smoother and shows us the longer-term picture. The real magic isn't in either line by itself, it's all about how they interact with each other.
And here it is in action. See the orange line? That's our fast 10 SMA, and the green line is our slower 20 SMA. Now just look at this. Through this entire uptrend, that faster orange line stays consistently above the slower green one. That's the confirmation we need. That's the signal.
See, focusing on this relationship gives us a whole new, much more reliable set of rules. It helps us filter out all that confusing noise and focus on the real trend.
So here are your new rules. This is what you need to burn into your brain. For an uptrend, the faster moving average has to be above the slower one. And for a downtrend, the faster moving average has to be below the slower one. Simple, right? No more getting tricked by one little price spike.
By focusing on how these two lines are behaving with each other, instead of just watching the price cross a single line, you get a much clearer signal of what's going on. This is what helps you stick with the real trend and stop jumping the gun on those false moves.
So adding that second line, it's a really simple tweak that adds a super powerful layer of confirmation to your trading.
And now that you can spot the trend with a lot more confidence, the big question is, what's next? What do you actually do with this info? How do you find that perfect moment to get in and, just as important, to get out? Well, that, my friends, is the next piece of the puzzle.